Good morning, it's Jonathan Barratt with this week's Market Buzz, and lots to talk about today. As soon as the markets opened, everything went berserk. Oil prices up 25%, gold prices a little bit lower, and a lot to happen in there, particularly with the war between US, Iran and Israel. Okay, so lots happening on that front. But first of all, let's just have a bit of a recap. I think this is important just so we set the tone. Obviously, we're day 10 into the conflict. Energy commodities are surging. That's WTI, Brent. In fact, the WTI contract has taken over, used to trade at a discount, taken over Brent. Natural gas in the UK is up 77% since the conflict, and which is another major concern. US equities on the back of that, they've tumbled, they're down 1.4%. In Asian trading today, they're down another 2 to 3%. Also, non-farm payrolls last week came in down 92,000, which shows the economy is really not doing what it's doing. Previous to that, we had issues in China in terms of the economy sort of not performing where we'd like it to perform, and so there are issues there across the board. The PBOC still out there buying gold. 16th month in a row, so there are some concerns there. And Australia GDP up 0.8%, and year on year is up 0.226%, which is obviously an inflationary problem for the RBA, and that's a concern, which, mind you, with what's happening in the markets now, is a concern across the board. So in this week's Market Buzz, we're going to talk about the oil market. We're going to talk about what are the implications for the broader economies, and where do we see prices moving from here. As I mentioned, they're up 25% just today. So basically, if you're taking since the move, they're up around about 45%. Now, the Straits of Hormuz is closed, so that stops 20% of seaborne oil reaching the market. Those economies that rely on oil and natural gas will have problems. Remember, the Straits of Hormuz not only ships oil, but also natural gas, liquefied natural gas. So in terms of that, it's a double whammy. Now, what have we seen? The price rises have been so dramatic. The conflict, I think if it continues the way it's going, and remember, we've sort of got this impression that Trump turns off and turns on wars, but this one they feel will go on for an extended period of time. When we say that, it's about 3 to 4 weeks. It'd be interesting to see whether Iran can actually last that long. If it's done, then they've done a lot of planning. But what it does mean, and I think this is the concern that we've really got to focus on, is a sustained price rise like 1970 oil shocks, like the most recent one, the 2022 oil shocks. They have this cost-push inflationary environment, or they contribute to a stagflation. Now, that to me is a major concern, because I think when you look at the reopening of the Straits of Hormuz, will that just happen when they turn the war off? Well, not the case. The reason why the Straits of Hormuz has been closed is that not only is there potential attacks, but also the liability of insurance should that happen. Insurers have turned around and said that they won't insure boats going through there. So that to me is one area, or the cost is prohibitive. So it is a major issue, and with that major issue there, you're seeing no traffic at all. Now, what that will do is, even if the war ends, it's going to keep prices elevated until we can get to a state of normality. And I think whilst you've got a deflated country that probably will not win this war, and no one wants to negotiate, but even on a negotiation, you're still going to have concerns. And because it's a very thin track of seawater, it's always open for speculation. It's on attack. It's always a worry. So I think it's just going to last a lot longer until there are guarantees that ships can go through the Straits of Hormuz and sort of into the markets that need it. Now, when you look at it, some markets like Japan and India, Japan today has been hit quite hard, down about 6-7%, its equity markets. That is a concern. Japan imports 100% of its energy needs. And with that type of concern, this oil shock will be longer lasting. So I don't think you can ever dismiss the fact that the price will come down very quickly, it will remain elevated for some time to come. Whether it's elevated at 90 to 85 as opposed to 110 and 115 is probably the case, but it will be elevated. And with that, we will see this cost-push stagflationary environment maintain itself for some time. That comes up with policy issues for most central banks. When we look at the Fed, we have a government, or we have a Trump who's trying to influence the Fed with its board members. Now, interestingly, whether or not those board members will do anything, I think the current front runner will say he won't. In fact, he'll keep rates where they are, unlike Donald Trump, who wants him to lower rates. So I think that is why we'll see equity markets continue to be under pressure, because you do have this concern. Now, every time we've had an oil shock before, this is what has happened. We have this inflation. And because we've got inflation already quite sticky in the market, then that is further adds to the problem, because if it's not going down, it's only got one way to go. And it's certainly not going down from here, although the last read was actually quite supportive at 2.4%. When you look at the correlation between oil and inflation, you actually see that they track each other quite well. So that gives us that lead that we're going to move into an inflationary environment. And further, it gives that lead that perhaps some economies might actually fall into a recession. And that, to me, is also a concern. Other economies will weather this much better than others. So when we do look at it, there's a change and there's a repositioning. Equity markets will come under pressure, oil will remain sustained, and you'll find the US dollar probably be steady. Some economies, particularly the Indian economy, which only a couple of months ago was doing all the right things, that will have a correction. But then that'll also represent an area to buy. When we look at Australia already has an inflationary problem. The RBA has already lifted rates. So what does that tell us? If the RBA is going to have to lift rates even further, that's going to be a little bit more of a concern, because that inflation is really going to stick. And as a result of that, rates will go higher, a lot higher. So that to me says that Australia potentially could fall back into a recession. This is more of a drawn out type of scenario. But for where we are at the moment, today's trading, it's all about oil prices at these levels. They are a little bit overcooked at 115. I think they will come lower once the market settles down. But whatever it is, we will be heading into an inflationary environment, which everyone will have to monitor. And to me, that's probably one of the big ones. Okay, let's just have a look now at some of the markets. The Brent, well, there we have it. The Brent contract. Brent in daily and hourly, as you can see, it's right on that top side here, right up here, got as high as just under that 120. Now, I don't think that's sustainable up there. If anything, it should come back a little bit. I think this is fear driving this market. I think the most important thing to think, if you lose 20% of supply, then that warrants a 20% increase in the price. We've done over that. And I think with that, you'll probably see some more of a correction. So with anything there, I think oil prices will come back. There's going to be a lot of concern that will promote it higher. The regional spray that Iran's given will provide more of a hiccup. Prices will be sustained at these levels, perhaps over that or 100 level. But at these levels here at the moment, I think on the day, it's a little bit overdone. And as you can see here, we just get that's the hourly chart there for the Brent contract. Interesting to see Brent and WTI trading together. There's the Nasdaq once again under a little bit of pressure, quite a bit of pressure, down 1 to 2% on that today, and I think that will continue. Now, having a look at some of the other contracts, if we look at gold will not trade well at the moment, mainly because people will use it to basically get out of positions so they can fund margin calls. Do think that we might get a flight to quality gold pretty soon, but we need to get a brave that 5200 area. If we do get 5200, then I'm quite happy to continue to buy. We remain long gold, just like we're short, long the oil, and we're also short the S&P. So I'm quite happy about that. When you look at the same scenario there with the silver, long silver there, I would like to see a breakthrough 83.50. If that happens, then I know we're heading back to the top end of the range. And if anything, it's a good buy opportunity actually here with a stop close by. And I think having that stop close by, which is below the low of the day today, is not a bad trade whatsoever. So just in a nutshell, we remain long gold, long silver, long oil, short equity markets. We're in a good position. We're also long natural gas and also wheat also in a good position. So that's about it from me. Hope everyone has a good week's trading. We'll talk to you soon. Bye for now.